Stop everything you're doing right now. Put down the coffee. I'm John A.G., and you need to understand what just happened on Friday, March 6th, because two numbers crossed historic thresholds in the same week, and neither one is making the mainstream news cycle. COMEX registered silver fell below 80 million ounces for the first time in this entire bull market. In that same week, the LBMA published its end of February vault data, showing that London is now holding less than 3 ounces of silver for every ounce of gold in its vaults. Two thresholds, same week. And then on top of those two, the private credit market delivered a third signal that almost nobody is connecting to silver. We're going to cover all three today, with every number sourced and verified. Before we go anywhere, drop a comment below. Bullish or confused? One word. I want to know where your head is after what I'm about to show you. This is Currency Archive. Let me start with the COMEX depository report from Friday, March 6th, because I want to go through every single vault line by line. This matters because when you see 5 separate vaults all moving in the same direction on the same day, that is not noise, that is coordination through market pressure. Every vault operator is responding to the same underlying signal. The people who own silver want it out of the COMEX system. Asahi Vault reported 1,169 to 300 ounces physically withdrawn from the system on Friday. Not adjusted, not reclassified, withdrawn. The metal left the building and entered private hands, whether that's a refinery, an industrial buyer, or an institutional account that no longer wants its silver held inside a futures exchange system. Brinks reported 150 ounces adjusted out of the registered category, meaning the metal is still physically in the Brinks vault, but it has been removed from the pool that COMEX can draw on to satisfy a delivery notice. CNT Vault reported 446 ounces physically withdrawn, gone from the system entirely. MTB reported 2 separate movements on the same day, 1,284, 642 ounces physically withdrawn, plus 458, 744 ounces adjusted out of registered, meaning MTB alone contributed 1,743,286 ounces of combined removal from the deliverable pool in a single session. When a single vault removes that volume in one day, it indicates that a large institutional or commercial account made a deliberate decision about custody. StoneX reported 345 ounces adjusted out of registered. 5 vaults, 5 separate movements, all in the same direction. Now add up only the registered category changes across all 5 vaults. What is 145,139 ounces removed from the deliverable silver pool in a single Friday session. The new registered total, 79,988,584 ounces, below 80 million ounces for the first time. When you add the physical withdrawals and the registered adjustments together, the total COMEX vault system lost 2,857,923 ounces on Friday alone. The combined vault now stands at 386,287,971 ounces. To give that number its full historical context, in October 2025, before the current delivery crisis escalated through its most intense phase, the total COMEX vault was close to 532 million ounces. In 5 months, roughly 185 million ounces have left the combined COMEX system, a 35% decline in total inventory in just 5 months. In commodity markets, a 35% inventory decline in 5 months is an extraordinary rate of depletion for an asset that takes years to mine and refine. The registered number is what matters most for delivery mechanics, and it is now at 79.9 million ounces. For context on how dramatic this is, COMEX registered silver peaked near 240 million ounces in 2020. The current level represents a 66.7% decline from that peak. 2/3 of the deliverable silver that existed 5 years ago has either been physically removed from COMEX vaults or reclassified out of deliverable status. There is an important distinction between those two outcomes that the bear case on silver consistently ignores. When silver is physically withdrawn, it leaves the exchange and enters the real economy. When silver is reclassified from registered to eligible, it is still in a COMEX vault, but it no longer counts as available for delivery. Both movements reduce the registered number, but only physical withdrawal permanently removes silver from exchange inventory, and both are happening simultaneously. That is why the total vault number and the registered number are both declining, but at different rates. The registered pool is being squeezed from both ends, physical exits at the bottom, and reclassification pressure from holders who want control of their metal without formally removing it. This eligible versus registered distinction matters enormously because it is the source of the most common misunderstanding about COMEX silver capacity. The total COMEX vault at 346,287,971 ounces sounds like a large number. It's more than 4 times larger than the registered number. The common bear argument is that eligible inventory represents a reserve that can be converted into registered at any time, replenishing the deliverable pool and preventing any delivery crisis. That argument has a serious problem. The eligible silver belongs to specific parties who have deliberately chosen not to make it available for delivery. They moved it from registered to eligible at a specific time for a specific reason. To assume eligible silver will voluntarily convert back into registered under delivery pressure is to assume those holders will change their decision precisely when changing it costs them the most, because a surge in registered supply during a delivery squeeze would push prices down, reducing the value of their own inventory. The incentive structure runs in the opposite direction. Eligible holders have every reason to wait while registered depletes, and no institutional reason to convert and rescue the short side of the market. The 5 vaults that moved silver on Friday, Asahi, Brinks, CNT, MTB, and StoneX, represent the full spread of major COMEX custodians. This is not one vault operator making an internal decision. It is the entire institutional ecosystem of COMEX silver storage, responding to the same pressure simultaneously. When all 5 major custodians move in the same direction on the same day, you are looking at a market-wide signal, not a technical adjustment. Those decisions do not reverse automatically when the calendar turns to Monday. Now, let me bring in the open interest data from Friday's close, because this is where the registered number becomes immediately dangerous rather than just historically notable. The March 2026 contract showed 1,281 contracts remaining at Friday's close, with a change of negative 366 contracts on the day. Here's the critical detail. 0 deliveries were processed on Friday. The entire 366 contract decline came from rollovers and position closures, not from physical delivery. Thus, 281 contracts are still open in a delivery month that is approximately 3 weeks from final expiration. At 5,000 ounces per contract, that equals 405,000 ounces of silver still potentially standing for March delivery. The March delivery season has already seen approximately 33 million ounces delivered. So when the remaining 6,405,000 ounces deliver, total March delivery volume approaches 40 million ounces, ranking March 2026 among the largest delivery months in COMEX silver history. The exchange processed 40 million ounces in a single contract month against a registered vault that is simultaneously draining. When those 6,405,000 ounces are removed from registered, the vault falls from 79,988,594 ounces to approximately 73,594 ounces, before May 1st notice day on April 30th has even arrived. Now look at May. The May 2026 contract showed 76,948 contracts at Friday's close, representing 340,000 ounces of paper silver, standing opposite a registered vault heading towards 73.6 million ounces. That is a paper-to-registered ratio of 5.2 to 1 for the May contract alone, before accounting for any April deliveries, any further withdrawals between now and April 30th, or any additional registered to eligible reclassifications. The second development from this week is the LBMA Vault data published for end of February 2026, and I want to spend significant time on this because the number is being underreported everywhere I look. The LBMA London Vault data show that as of the end of February 2026, London Vaults held 9,210 tons of gold and 27,065 tons of silver. The silver figure represents a 2.4% decline from the previous month, with January 2026 holding approximately 27,529 tons, meaning the monthly drain in February was roughly 664 tons of silver leaving London vaults in a single month. At 664 tons per month, London is losing silver at approximately 7,968 tons per year. At that pace, without any acceleration, the LBMA silver vault reaches approximately 19,065 tons by the end of 2026. Now compute the ratio that nobody's talking about. 2765 tons of silver divided by 9,210 tons of gold gives you 2.939 to 1. The LBMA London Vault holds 2.94 ounces of silver for every ounce of gold, below 3 to 1. To understand why that number matters beyond being a round number threshold, you need to understand what the correct ratio should be if London Vaults reflected the physical reality of how silver and gold exist in the earth. Global silver mines produce approximately 820 million ounces of silver per year, while global gold mines produce approximately 104 million ounces, a geological extraction ratio of approximately 7.88 to 1. For every ounce of gold pulled from the ground, nearly 8 ounces of silver accompany it. The LBMA vault ratio is 2.94 to 1. Geological reality is 7.88 to 1. London is holding silver at 62% below the natural production ratio relative to gold. If you wanted the LBMA to hold silver proportional to its gold holdings at the geological ratio, it would need to hold approximately 72,575 tons of silver against its 9,210 tons of gold. It holds 27,065 tons. The gap between what London has and what geological proportionality would suggest is 45,500 tons of silver. That silver does not exist in a vault somewhere waiting to be redeployed. It exists in solar panels on rooftops across China, Germany, and the United States. It exists in circuit boards inside every smartphone manufactured in the past decade, in the electrical systems of electric vehicles rolling off assembly lines in every major auto-producing country. It has been consumed by the industrial economy across 6 consecutive years of structural deficit, and it will not be recovered at current recycling rates on any timeline that matters for the next delivery cycle. The gold to silver price ratio is approximately 60 to 1 today, with gold at $500 and silver at $87. The LBMA vault ratio is 2.94 to 1. The price says silver is 60 times less valuable than gold. The vault says there are only 2.94 ounces of silver available for every ounce of gold in institutional storage. The deeper that divergence becomes, the larger the eventual price correction required to bring them back into any rational relationship. In 2020, when LBMA silver peaked at 35,667 tons, the silver to gold vault ratio was at its most comfortable. 5 years later, the LBMA has lost approximately 8,600 tons of silver from its vault, roughly 276 million ounces permanently consumed and removed from institutional availability. The vault went from comfortable to below 3 to 1 in just 5 years of structural industrial deficit. To understand what this vault depletion means in the context of past silver bull markets, consider what the LBMA situation looked like during the 2 most significant silver price events in modern history. In 1980, when the Hunt brothers drove silver to $50 per ounce in nominal terms, the market was operating in a world of genuine silver abundance relative to industrial demand. Above-ground stocks were enormous. The price spike was driven by concentrated speculative demand, meeting adequate physical supply. And it was broken by rule changes that banned new silver purchases on margin. The supply side was not under structural stress. The 1980 event was a financial squeeze on top of a fundamentally healthy physical market. In 2011, when silver reached $49.75 per ounce, the world had not yet experienced the solar panel demand wave that was still several years from reaching its current scale. Electric vehicles were a rounding error in global silver demand, and the structural industrial deficit that began in 2021 had not yet started. The LBMA silver vault in 2011 held approximately 25,000 to 30,000 tons, roughly comparable to today, but without 6 years of annual deficit eating into that buffer. The 2011 event was broken primarily by 5 consecutive margin hikes on COMEX over 8 trading days, a deliberate exchange-level intervention that raised the cost of holding leveraged long positions and flushed speculative positioning. In both 1980 and 2011, the London vaults had more structural capacity to absorb delivery pressure than they do in March 2026. The current situation adds 6 consecutive structural deficits, a depleted LBMA vault at 2.94 to 1 against gold, a COMEX registered at 79.9 million ounces, China export controls eliminating the Eastern arbitrage route, and Shanghai physical market paying $13 above New York. Neither the 1980 nor the 2011 bull market operated against that combination of supply-side conditions. The tools that broke those markets, rule changes and margin hikes, have already been deployed in the current cycle. COMEX raised margins from 15% to 18% in February. Silver fell from its highs and has since recovered. The margin weapon has been used and partially absorbed. The next resort would be cash settlement, the conversion of physically settled contracts into cash payouts at an administratively determined price, which would represent a structural acknowledgement that physical delivery cannot be guaranteed. Now let me explain the third development and why I think it is the most underappreciated signal in the current market. Last week, the private credit market in the United States entered what is being called a gating wave. And here is exactly what happened with specific numbers. BlackRock's private credit arm received withdrawal requests totaling $1.22 billion from one of its funds during the first quarter of 2026, representing 9.3% of the fund's total net asset value. The previous quarter's withdrawal rate was 4.1%, meaning redemption demand more than doubled in a single quarter. The fund distributed $620 million before hitting its 5% quarterly redemption cap and stopping, leaving investors who submitted withdrawal requests above that threshold unable to access their capital. At almost the same moment, Blackstone's BCRED fund, an $82 billion private credit vehicle, saw redemption requests reach 7.9%. Blackstone raised its usual cap from 5% to 7% to accommodate more requests, then injected $400 million of its own proprietary capital into the fund to honor all outstanding withdrawal requests. Let that sentence sit for a moment. The largest alternative asset manager in the world voluntarily wrote a $400 million check to stabilize one of its own funds. Nobody writes a $400 million check to support a fund unless the consequences of not writing that check are materially worse. Blue Owl went further than both. It permanently halted quarterly redemptions and is liquidating $1.4 billion in assets. Not a temporary gate, but a permanent structural halt while assets are forced sold to raise liquidity. Apollo Global Management, KKR, Ares Management, and Carlyle Group all declined between 5% and 6% in sympathy as investors reduced exposure to the alternative credit sector across the board. The systemic dimension that makes this relevant beyond finance. U.S. banks had extended approximately $300 billion in loans to private credit providers and an additional $285 billion to private equity funds as of mid-2025. Total banking exposure to the alternative credit complex of approximately $585 billion. When private credit vehicles gate simultaneously across BlackRock, Blackstone, and Blue Owl, the question every risk manager at a large bank is asking is which of their lending relationships are tied to the vehicles that are gating, and what does forced asset liquidation by those vehicles do to the collateral values underpinning those loans? Bill Eigen, who runs absolute return fixed income at JP Morgan Asset Management, told CNBC last week that the opacity and leverage in the private credit sector is concerning. That is a remarkable statement from someone inside the largest U.S. bank by assets. Eigen is not a retail newsletter writer. He manages institutional fixed income capital for JP Morgan. When someone at that level uses the word concerning publicly about a sector with $585 billion bank exposure, he is describing something visible from inside the institutional system. Steve Eisman, the investor whose positions during the 2008 housing crisis were documented in The Big Short, described private credit's ties to the insurance industry as a slow brewing scandal. His estimate is that over 20% of the $1.8 trillion private credit market is exposed to software buyout loans underwritten before artificial intelligence existed. The core of that argument is that a large portion of private credit was extended to software companies valued at multiples that assume no AI disruption of their revenue model. AI has disrupted many of those revenue models, yet the loans remain on books at original valuations because private credit marks assets quarterly with significant management discretion, unlike public debt, which reprices in real time. This matters for silver because insurance companies are major investors in private credit funds. When an insurance company's investment portfolio takes losses or becomes illiquid through gating, the insurer faces pressure on its capital adequacy ratios set by regulators, and insurance companies under capital pressure reduce risk across their portfolios by liquidating liquid assets to maintain required ratios. Physical gold and silver are not on insurance company balance sheets in significant size, but the systemic pressure of insurance capital rebalancing across the broader market creates flight to quality flows into assets with genuine scarcity and no counterparty risk. The cascade from software loan impairment to insurance capital to precious metal rotation is not direct, but it is the mechanism through which financial system stress historically ends up reflected in gold and silver prices before the full scope of the stress is publicly acknowledged. This is the cockroach principle applied to private credit. When one major fund gates, you're not looking at an isolated management decision. You are looking at the visible symptom of a systemic liquidity and valuation problem that exists throughout the private credit complex. Now here is the connection to silver that almost nobody is making. The investors behind gating clauses at BlackRock, Blackstone, and Blue Owl cannot access their capital. They submitted withdrawal requests and were told no. Those investors have other assets, liquid assets they can sell on their own timeline without asking permission from a fund manager who is protecting the fund over protecting the investor. Physical gold and physical silver are globally liquid, have no counterparty risk, have no redemption cap, and cannot be gated by any intermediary. The contrast between capital trapped in a private credit fund and metal sitting in your own allocated vault account is exactly the contrast that drives rotation toward precious metals during a credit confidence crisis. This rotation does not require a bullish thesis about silver supply and demand. It only requires people who have been told they cannot access their paper capital looking for something they actually control. The ICBC and ABC Gold Bar sellout data from March 4th covered in the previous video is the retail expression of this dynamic in China. Consumers walking into app-based banking interfaces and finding no investment gold bars available. The private credit gating is the institutional expression of the same dynamic in the United States. Different scale, different mechanism, same underlying driver. The paper system is revealing that its promises of liquidity were not unconditional. The Shanghai premium at $13 over COMEX brings all three threads together into a single price signal. Shanghai silver is trading between $95 and $100 per ounce, while COMEX is at $87. A $13 premium has persisted for weeks, despite being theoretically profitable, to close through arbitrage. Traders cannot close it because there is not enough physical silver in Western vaults available for eastward shipment at the required scale. China implemented export controls on refined silver on January 1st of this year, severing the eastward arbitrage route that previously allowed metal to flow from China to London or New York when Western inventories tightened. The route now runs in only one direction, from west to east, and even that direction is constrained by the physical vault levels already described. The Shanghai Premium creates a structural floor for COMEX silver. Any holder of physical silver in a Western vault has a standing bid from the Chinese physical market, with Shanghai paying $95 to $100, and the landed cost of Western silver into China, after accounting for China's 13% value-added tax on silver imports, shipping, insurance, and logistics, reaching approximately $80 to $82. The rational Western silver holder does not sell below that level. The premium is the mechanism through which physical scarcity in the world's largest silver-consuming nation sets a minimum price for paper in New York. The macro backdrop adds stagflation to the list of pressures. The Dow fell 361 points on Monday, oil is trading above $100 per barrel, and stagflation fears are the dominant institutional narrative, as inflation remains persistent while economic activity softens and private credit. Stress raises recession risk. In traditional inflation environments, the Federal Reserve raises rates, the dollar strengthens, and silver comes under pressure because the opportunity cost of holding non-yielding metal rises. In stagflation, the Fed is structurally paralyzed. It cannot raise rates aggressively into a softening economy without risking a hard landing on top of already stressed credit markets, and it cannot stay passive while inflation runs. Silver's industrial demand does not respond to rate signals. Solar installation programs are 20 to 30-year infrastructure commitments, and electric vehicle production lines run multi-year procurement contracts with silver specifications locked at the engineering level. The industrial floor for silver demand is effectively insensitive to whether the Fed funds rate is 4% or 5%. What changes under stagflation is the monetary premium and investment demand, and both move higher as institutional confidence in paper claims deteriorates. The numbers that will determine the next 8 weeks are specific and unambiguous. COMEX registered is at 79,988, 594 ounces. March deliveries have approximately 6,400 and 5,000 ounces pending, bringing post-March registered to approximately 73,583,594 ounces. May open interest at Friday's close was 76,948 contracts, representing 384,740,000 ounces of paper silver, with May 1st notice day on April 30th. The paper-to-registered ratio for May against post-March inventory is 5.2 to 1. Let me walk through the May delivery scenarios in specific numerical terms so there is no ambiguity about what the math looks like. If 10% of May open interest stands for delivery, that is approximately 7,695 contracts, roughly 38.5 million ounces against post-March registered of 73.6 million ounces. A 10% delivery request alone consumes 52.3% of the registered vault in a single month, leaving the registered vault at approximately 35 million ounces before the June contract begins. If 20% of May open interest stands for delivery, that is approximately 15,390 contracts, roughly 76.9 million ounces, which exceeds the entire post-March registered vault of 73.6 million ounces. A 20% delivery request on May, open interest cannot be fully satisfied from registered inventory, even if 0 additional silver leaves the vault between now and April 30th. Forcing the exchange to source metal from eligible holders, convert inbound shipments, or pay cash premiums to induce delivery deferral. If 25% of May open interest stands for delivery, that represents 96.2 million ounces against a registered vault that has at most 73.6 million ounces, a gap of approximately 22.6 million ounces that the exchange must source from outside the registered pool. These are not extreme scenarios. The March delivery rate was approximately 33 to 40 million ounces out of a contract that entered the delivery month, with roughly 260 million ounces of open interest, a delivery rate of approximately 13 to 15%. A repeat delivery rate in May produces a registered crisis that is arithmetically unavoidable. The only resolution paths are eligible to registered conversion by holders who currently have no incentive to convert, emergency inbound shipments from the LBMA or other foreign sources, or cash settlement at an administratively determined price that effectively breaks the physical delivery promise. LBMA silver is at 27,065 tons against 9,210 tons of gold, a vault ratio of 2.94 to 1, below 3 to 1 for the first time, declining at approximately 664 tons per month. Private credit at BlackRock, Blackstone, and Blue Owl has gated simultaneously with $585 billion of bank lending to the alternative credit complex as the systemic backstory. Shanghai is paying $13 per ounce above COMEX for physical silver that cannot be arbitraged away because the physical inventory to execute the trade does not exist in sufficient quantity. The crisis is delayed. It is not averted. Every delivery month that processes large volumes without a formal default is presented in the financial press as evidence the system is functioning. What it actually represents is the registered vault moving progressively closer to a level where normal delivery processing becomes structurally impossible, while the open interest of the next delivery month sits unchanged at 384.7 million ounces. The LBMA vault ratio is confirming the same depletion story at the institutional clearing level that COMEX registered is confirming at the exchange level. The private credit gating is confirming that the financial system's confidence in paper claims is deteriorating at the macro level. Shanghai is confirming that the physical market has already repriced well above the paper market, and the arbitrage mechanism that should close the gap cannot function because the metal is simply not there. One word in the comments, bullish or confused. That is all I want right now. If this video gave you a clearer picture of what is happening in the physical silver market behind the paper price, share it with someone who needs to see this data. This is Currency Archive. Every number in this video is sourced and verified. I will see you in the next one.